Hi, I'm Josh Goodbody from Team Qredo, and this is a closer look with the Qredo founders, Anthony Foy and Brian Spector.
Very, very warm welcome to you both.
Thank you, Josh.
Thank you very much.
Good stuff. Well, why don't we kick off with some introductions? Brian, do you want to start?
Sure. I'm Brian Spector. I'm the Chief Product and Technology Officer here at Qredo and co-founder. My background before getting into crypto was actually in a space called enterprise cryptography way a long time ago. Spent most of my formative years in Silicon Valley working for companies like RSA Data Security and McAfee, and then moved over to the UK about 10 years ago, ran product at a company called Encipher, which is up in Cambridge. They did the largest, were the largest manufacturer of hardware security modules. So those are the kind of boxes that you stick encryption keys inside of, and sort of like Mission Impossible. You look at it and then blow up, right? If you looked at it the wrong way. And we sold a lot of those to banks and financial service firms and intelligence agencies and folks like that that really had high security applications. And that's where I got into hardware security, really. I have my own startup called Miracle with a fellow named Dr. Michael Scott, who's kind of a preeminent leading light in elliptic curve research, elliptic curve cryptographic research. And we had a low-level toolkit that we sold to chip manufacturers, which was reflected in the algorithm of or the acronym of our name, which was Miracle, stood for Multi-Precision Rational Integer Cryptographic Library. So as you can probably imagine, it was very low-level geeky stuff. And about 2014, 2015, Bitcoin started really blowing up. I know me and all the cryptographers that were working at Miracle at the time were like, gosh, we're selling low-level runtimes to chip manufacturers. We could be working on Bitcoin. So we finally got our chance when we exited out of that company in 2016. And we started working on what has now become Qredo really in earnest in 2017 and 2018. And yeah, that's me.
Great. Okay. Anthony, tell us a little bit about yourself and maybe the story behind how you guys met and started collaborating.
Oh, yeah, sure. Yeah, I'm Anthony Foy. I'm the CEO and co-founder along with Brian. I've really been in partnering with technologists like Brian, identifying very early on product market fit, scaling the organizations, and then have had a multitude of successful exits as a result of those partnerships. I met Brian in, I believe it was 2015 when we first met. I was the CEO of another startup technology company that was building an application in the legal technology space, and the application that Brian had built at Miracle, there was an offshoot of that which was relevant to the application that I was building, and I actually made an offer, tried to buy the company. Unfortunately, that deal didn't come through. But
I blew that up, by the way. I'm just going to interject there. That was my fault. Sorry, go ahead.
But that didn't hamper us. We actually got to know one another, became friends. We reconnected in 2016 after he had sold Miracle. And then in early 2018, he came to me with this concept that he had been working on, and we started at that point kind of shopping it around, talking to lots of different participants across the market, large banks, brokers, institutions, about their thoughts of how they were going to enter the digital asset marketplace and the requirements that they would have in order to be able to do that. And so in 2018, I made an angel investment into the company. In 2019, I sold my last company. And in 2019, I made a more significant investment. And then I joined as CEO to build Qredo with him and the rest of the core team that he had already assembled.
Awesome. Okay. So more than 2 years in the making, huge milestones have been met throughout that time. You know, we're finally pulling the hood off the Qredo team, the Qredo business, and talking about what it is that the team have built. And recently, as we all know, the Qredo token announcement was made. So we're finally able to talk about the path and the journey that we're on to decentralization. So we've got so many things to try and cover today. We'll try and take those in bite-sized chunks. But let's start with Qredo. Let's start at the very top. If you had to someone who's never heard of Qredo, if you had to try and describe Qredo in a couple of sentences, how would you start? Perhaps you kick us off, Brian.
Qredo is like a lockbox that's controlled by a number of decentralized and organizationally independent entities that use a blockchain to figure out who can transfer stuff in between that lockbox. So if you've got multiple people using that lockbox and you put your Bitcoin in it, and I know, Josh, that you've got your Ethereum in it, I can basically say, hey, Josh, could you give me some of that Ethereum? I'll give you some of my Bitcoin. And we could agree to a sale price, but we'd actually also want to make sure that the folks that we appointed as custodians, and maybe there are people that have to approve those trades that are kind of like custodians on top of our shoulders looking over, or compliance people, that they have the opportunity to do that too, and that those interactions actually all get recorded on a distributed ledger. So you can kind of think of it like, at the minimum, it's a safe that uses a distributed ledger to figure out who can open it and who can close it, and who can pull what out, and who can put stuff in. But it also uses that distributed ledger to figure out, well, of the people within that safe, what can they trade amongst themselves? And so when you kind of start talking about decentralized custody, it's really moving away from having somebody record ownership asset information inside of a database, which, you know, doesn't have any data durability or data immutability, which is really what financial services firms want. And you put that on a ledger, well, you get all of those characteristics, you know, and more. And it's just, it basically comes about from the cognitive dissonance I think me and my team had when we started looking at blockchain. We're like, as we got educated on it, we're sort of like, so wait a minute, let me get this straight. People are buying into this whole decentralized universe, which is great, but they don't feel comfortable enough storing their own Bitcoin. So they're going to send all of their Bitcoin to somebody who basically can put a storefront up and say, hey, I can protect my private keys better than you can protect your private keys. And that to us just seemed really crazy. And there must have been a better way, but at the time, nobody was talking about, you know, a decentralized custody concept. And I remember when we started talking about it, people were looking at us like, you know, what are you guys, what's in your Wheaties this morning? So we persevered and we kept at it, and the market obviously has moved our way, and, you know, now is realized, obviously, with sort of these high profile hacks, or I guess arguments or disagreements about, you know, who screwed up what at what centralized custodian. They recognize that having a consensus-driven model about asset ownership is probably the right way to go. So, you know, it feels good.
Nice, yeah. So I guess then on that topic, Anthony, decentralized custody and the why. Lots of people go, hold on, let me understand this. Why would you decentralize custody? What are the benefits that come with that? And what is the kind of advance that Qredo brings along with that? How would you kind of unpack that?
I think I'd back up even a little bit further and talk just a bit more about what it was originally that attracted me to participate and invest alongside Brian in this. And it's just the thesis that we were moving into a world where there's a multi-chain universe, where there would be a multitude of chains, a multitude of assets, and the specialization that would happen across these multitude of blockchains. And those values would need to be protected. They would need to be able to be traded. They would need to be able to be moved. They need to be able to be audited, and some sort of governance written around that. And that really is what kind of attracted me to this, because I saw that what Brian and his team had conceptualized was this idea of being able to create this multi-chain universe where you could hold securely the underlying assets, allowing the end users to bring their own governance control over those assets. So not having to depend upon a third party, not having to depend upon a middleman, not having to depend upon anybody other than the ones that they want to have nominate to have control over those assets. And then from that position where, as our tagline says, the network is the vault. So once from that position, I can now be able to move my assets within this network between any other counterparty across the network. And I really think that that's the direction that this market is going in, is that there is going to be a continuing growth of assets and asset types and blockchains and blockchain capabilities. And there will be always a need to, one, store those, two, to be able to have a governance structure over the top of it, but an ability to be able to transact on those, because ultimately that's what people are trying to do in these financial systems, is they want to be able to transact on the value in order to be able to capitalize on opportunity. And that really is kind of the fundamentals around what Google has built, is allowing for the safe storage, the governance structure, and an ability to be able to transact across multiple chains.
Yeah, so cross-chain interoperability is one of the hottest kind of topics in the space right now, and different projects have tried to, pull this off in various ways. And all the solutions we've seen to date have had some kind of compromise, whether it's security, it's speed, it's cost, and we've seen, admirable, examples of first-generation cross-chain projects. And they've kind of paved the way for this. How different is Qredo when it comes to its cross-chain interoperability, and what kind of underpowers all of that?
It's I don't want to dive everybody down into the deep weeds and details, but there's a couple things, right? So at its core, what we do from a security standpoint, why our decentralized lockbox is really secure, is that there's no private keys being held to the underlying layer ones. So we do that through an advancement in cryptography called multi-party computation. So if you're a crypto guy, sorry, I'm going to talk for a couple minutes about MPC. But if you haven't heard this term before, it's literally the biggest thing to happen to cryptography since the invention of public-private key cryptography. And keep in mind, before public-private key crypto was invented in the 70s, thereabouts, the biggest thing that had happened to crypto in 2,000 years was the Caesar cipher. It was invented by Julius Caesar. Okay, so there's your quiz answer for the day, your pub quiz answer on crypto. What MPC allows you to do is to bypass the need to hold a private key to do what up to now you'd traditionally have to have a private key in your hand to do, which is to create a public key from that private key and to generate a signature on some document or a transaction, like a Bitcoin transaction, that you could have anybody verify with the public key that you just made, right? So from the 70s up until MPC, which is, really got moved from the theoretical to the practically applicable about 2 years ago. Up to that point, you needed to have a private key. Now, a private key is literally a whole mathematical form, right? You can't chop it up. You can't do any of that stuff. You have to actually store it in whole form. Now, the company I used to work for, Encipher, we made really good kit that would enable you to take an array of private keys and then encrypt them with a key that was held in this HSM. But you'd still have to back these encrypted private keys up. You'd have to run them through an HSM to decrypt them. And at some point in memory, they would be decrypted, right? So it was a good solution, but it had some weaknesses. And what MPC allows you to do is to take a group of decentralized computers and have them start talking amongst themselves in a protocol, literally kind of throwing big prime numbers back and forth at each other like throwing footballs. And at some point, if they say, hey, give me something to sign, and you all input the same thing for them to be signed, like the same Bitcoin transaction, and there's no difference in what they're going to sign. Let's say 6 of them are involved in this. At the end of that protocol run, at all the same time, they'll all output the same Bitcoin digital signature. Now, here's the kicker. You take that Bitcoin digital signature and you throw it into the Bitcoin network, a Bitcoin node's going to look at that and go, that's a beautiful pay to public key hash digital signature you got right there. Go on through. And the reason it does that is because by all accounts, it looks, smells, tastes, touches exactly like a pay to public hash digital signature that was generated by my mom's ledger address or ledger device in Peoria, Arizona, right? You just can't tell. It looks like a single private key, not a multi-sig, a single private key generated that signature. So there's a couple big, obviously, advantages to this. If I'm a hacker, my attack surface just got massively broad because I've got to go and attack those 6 computers to get the secrets out of those computers that would enable me to run the protocol by myself. Now, if those are well fortified computers and well protected, and if they're running in things like secure enclaves, that's going to be a big hill to climb. But the second thing is privacy. If I feed that to the Bitcoin blockchain or the Ethereum chain, it doesn't look like a multi-sig, right? There's no form that gives away what is the custodial mechanism behind that signature being generated. So they have no idea that there's this big custodial flow or governance flow that is kicked off and had all this work done behind it in order to prove that transaction. Just looks like a single private key signed it. And these are the huge quantum leaps in capability that MPC gives you. It gives you a much, much higher degree of security if you implement it right. And it gives you a much higher degree of transaction privacy because you can't tell what happened behind the scenes in order to generate that signature. Does that make sense? Okay.
Yeah, it definitely does. Yeah, definitely does. And we going through the process of speaking with different investors and different kind of potential clients, deciphering this for them has been the key challenge for us, I think. So speaking about it in a way that is accessible, because a trustless implementation of MPC has never really been done before, right? So that's one of the areas that Qredo has made its primary advancement in. What led you to this iteration of MPC versus what we see in first generation MPC technology?
Well, because just like you said, the first generation MPC technology made its way into first generation layer 2s that were trying to have these different bridges across the different blockchains, because what you want to use that MPC mechanism for is to generate that signature across for whatever blockchain you're supporting. And having a trustless implementation basically means there's no leader. There's no guy with a master secret. And basically, they just all kind of boot up by themselves and start working together to generate this secret. And what happens is what you want is you don't want a single entity kicking off that process. What you want to be able to do is have a trustless implementation, because that way you can program your MPC nodes with the logic to validate transactions that have already been put onto the blockchain. And I call that originally trust but verify. So if you have validators that are sitting there processing transactions to say, approve a swap between you and I, Josh, and that goes into the blockchain, or let's say more importantly, to approve a transaction where you're exiting out of our layer 2 onto Ethereum. Well, those validators have to make sure that your compliance team or whoever you self-nominated as a custodian over those assets in that wallet has also digitally signed that transaction, put that into the blockchain, and all is well. And then what happens is those MPC nodes are actually looking at the activity in the blockchain. So they're analyzing stuff block by block. And because there is no leader, because it is trustless, you can program the logic into those MPC nodes to go, hey, it looks like Josh wants to exit the network here with 20 Ethereum and send it to this address. Prior to them start throwing big prime numbers back and forth at each other, they'll look at each other and go, hey, did you guys see this? Did you see this? Yeah, it looks like we're all looking at the same thing. Let's now organize ourselves together and get Josh that signature he needs to exit the chain and spend that money on Ethereum. So that is the big difference. It sounds like, okay, well, that sounds sort of like an obvious, but it's that lack of obviousness, that lack of implementation thoroughness that is causing these hiccups in layer twos that, I don't want to name names or anything like that, but you can look for press releases and news sources that will tell you all about that. But that is why having a trustless MPC implementation enables you to create something called a consensus-driven MPC network, because those MPC nodes won't take orders from anybody. The only orders they're going to take is by them looking at the blockchain and going, yeah, we need to generate a signature. And that is inherently more secure by orders of magnitude than anything else on the market.
So this consensus-based MPC is at the heart of our security model, but then we've paired this with the layer 2 network. And so, Anthony, when you've looked at what's out there on the market and benchmarked what Qredo does versus existing layer 2s, they can be layer 2s, out and out layer 2s, they can be roll-ups, they can be scalability solutions. How does Qredo compare to those existing layer 2s that are out there? And I guess the really interesting thing about the layer 2 is that it is cross-chain interoperable. Tell us a little bit about that.
Yeah, that's kind of what the direction I was going to go, is because I think that, and coming back to this original idea about this multi-chain universe, right? What has happened as a result of this dichotomy that's existed across the market, where assets are getting centralized? They're getting centralized into custodians, they're getting centralized onto exchanges, they're getting locked into underlying layer 1s, and as well locked into layer 2s, and they're creating this fragmentation across the market. And the knock-on effect of that is that you end up with shallow markets, you end up with low levels of capital efficiency, you end up with a heavy burden on the participants in the market to be able to operate, manage, govern, audit all of the activity that happens. And in a system like Qredo has built, that is fundamentally what allows us to be able to unlock this fragmentation, these silos of liquidity that have existed across the market, because no longer are you being locked into one environment that is incapable of being able to communicate, or having to sacrifice security in order to be able to communicate. You're able to lock this in within a set of operating procedures that's immutable, it's fast, it's performant, and satisfies the internal requirements of your, not only your local jurisdiction around rules that are coming into force, but also internal procedures and governance that you have. And there really is not another solution across the market. I think that what you're seeing is these concentration of attempts to try to be able to deliver on this cross-chain capability, but no one has really thought through the fundamental foundation of security and what that security needs to look like, and what the resulting interoperability that has to come out of that security model. And that's what we've ended up with. That's where we've ended, is an ability to be able to knock down the walls of fragmentation without having to compromise performance, without having to compromise security, while adding a layer of governance and mutability over the activity that's taken place, to allow for large players and small players to participate comfortably in the markets.
I would also just add, as the final punchline on all of that, is once you put all that together, what you're able to do from a custodian or digital asset custody standpoint is move the market scope of custody out of being a rent-seeking mechanism where, okay, I've got to go pay for custody services, to now actually having custody be a profit center. So you can move the whole space from being rent-seeking to actually being a platform that provides yield. And that is exactly where we're going. And obviously the mechanism for us to do that is with our token launch.
Yeah, so the massive Pandora's box that gets opened when you realize that you can move layer 1 assets around on a instantaneous basis, on a cross-chain basis, between participants, between companies. The plethora of things that can be built on top of that is almost endless. You can build these swap pools, you can build liquidity pools, you can have yield generating applications built on top of it. Without being exhaustive, what are some of the most exciting things that you're seeing that people want to be building on top of the Qredo network?
Okay. I think, what we're constantly hearing from our investors and our partners is how do we, get higher and higher yields, but do it in a way that satisfies our compliance and regulatory safeguards, or compliance and regulatory mechanisms that we have to implement that show we are safeguarding our assets or our customers' assets. And that's easily done, but there's more kind of, I guess, even broader applications of that, which is you can take our ability to interface to various layer twos and have those arbitrage opportunities to make trades across those those different layer ones like Bitcoin and Ethereum, be done in a way that, from a liquidity provider standpoint, really lower the counterparty risk, but from a trader standpoint, can provide extreme liquidity to execute these strategies and have them be the most profitable they can be. And part of that is by making sure that they can get the most maximum amount of leverage that they can get. The other part of it is to make sure that they can execute those strategies in secret. As you know, MEV and front running and, all sort of nefarious activities, that now account for $1 billion in sort of economic value, just over the last, I think, 6 months alone on the Ethereum blockchain. I mean, that's kind of becoming almost existential crisis levels of value that are being taken away from folks who may have been investing significant R&D into these trading strategies. So for institutional players to move in and continue to adopt Ethereum, one of the big things that they need is to be able to have transaction and trade execution secrecy. And that, in addition to extreme leverage and high yielding returns and liquidity pools, those are areas of focus for what I call version 2 protocol. Does that make sense?
Okay.
There's some real low-hanging fruit as well in what we're delivering, just from the kind of a liquidity management perspective. The number of clients that are really crypto-native institutions that are coming on as customers and are investors. Using a layer 2 just at the very, very most basic level allows for a way to be able to manage the cost of settling across the existing layer 1, to eliminate gas fees, to eliminate congestion, in order to be able to capital in a much more transparent and low-cost fashion. And that's a real benefit that you can get out of initially deploying Qredo today.
Yeah, it's not sexy, but lowering gas fees is is something that right out of the box, as Anthony mentioned, that we can do straight away, which shows a very, very quick time to value.
Yeah, I mean, there've been so many things that I've observed that are hugely valuable to the industry that we can bring, and they range from things like, once we're integrated with a number of exchanges, Deribit being the first, where you have self-custodial wallets, the ability to move capital quickly to collateralize or recollateralize positions, so you don't have these cascading liquidations across different derivatives markets, can be solved by having a frictionless layer 2 network embedded with all these different exchanges. So there are structural things that Qredo can solve in my view, but there are also immediate requirements with some of the partners we're working with, like Deribit, like Celsius, that see the need for self-custodial wallets. And now what we're able to do at Qredo, which I think is one of the most exciting things, is embed self-custodial wallets into these centralized environments and have a centralized environment interface with the self-custodial wallet seamlessly. So you can hold your assets in your own wallet, under your own control, with your own governance, with your own rule sets, but you're able to interact with a centralized platform like Deribit, for example. But Deribit know at any time when they're due something, when they're due a margin call, when they, for example, liquidate a position, they can sweep those assets out of those wallets. So having this meeting of self-custodial wallets with a centralized environment for the first time, working seamlessly and working, hand in glove, is super exciting in my book. Because if you think about this, fast forward 6 months time, you've got one wallet with multiple venues connected to it. You've got your collateral sitting in one pot. That's portfolio margining. That is the holy grail of capital efficiency. So
You bet. Yeah.
that is one, that's one really powerful example of many that Qredo can solve today. So I think, that is coming very, very soon, and we're kind of in the integration hurdles with Deribit as the first kind of example of this self-custodial solution. But we've got many other things planned, and that really shows the capability of the Qredo network and especially the self-custodial wallets we have.
Funny, Josh, when we talked to Deribit initially, and we started talking to them about this, they were the first exchange that really kind of sat down for a second and said, "Oh my God, you guys can actually also reduce this frightening liability that we have by accepting customer deposits," which I'd always suspected. I'm like, man, it would make me pretty nervous taking in that amount of money all the time. But it was kind of the first time that we got glimpse that, wow, the ROI that we're going to save these folks by not taking in and not being a custodial mechanism for their customers' deposits when they really didn't need to be, was not only saving huge peace of mind, but liability, operational costs. That was a good feeling.
Yeah, absolutely. I mean, both from an exchange perspective, you take a huge burden, an operational burden, taking in that level amount of customer funds and all the operational complexity that comes with protecting and safeguarding them. And we've got myriad opportunities to point out where things have gone wrong. And also from a user perspective, whether you're a retail trader or you're an institution, some people rightly are nervous about putting large amounts of their funds on unregulated exchanges, because you never really know what standards they're being held under and where that, where those assets are being held. So we're kind of scratching both sets of kind of counterparties' backs, the users as well as the exchanges are deriving value from this. And I think in the fullness of time, that the industry will recognize how powerful the act of self-custody can be when it works seamlessly with a centralized environment. And that hasn't been possible previously because self-custodial wallets didn't have an integrated layer 2 settlement network. They only had API rights, which can be unilaterally yanked away by the user, right?
Yeah, and they also didn't have your ability to self-appoint your own custodians, which can be, third-party professional custodians that are operating Qredo clients that can programmatically offer access or, look at your trade limits, look at a certain trader's trade limits. There's so much that you can do there. And so we're not a threat to the centralized custodian business. I think we continue to make them relevant as time goes on and more folks adopt the Qredo network. But I think the ability to handle not only self-appointed custodians and to give them the programmatic capabilities to automate mechanisms to approve or reject transactions based on trade limits, the assets you're trading, all the usual stuff that, compliance officer, if you've ever had one sitting over your shoulder on a trade floor, is looking at you, while you're on your trading screen going, yeah, can you trade this asset or not? So all that can be automated as well too. And you can even switch back to, a manual screen with somebody sitting there going, okay, I approve that, I don't approve that. And I think that's also the first time that, a layer 2 has come out and said, we've built this to integrate into those complex compliance and governance flows that happen when somebody's trading a big ton of money in digital assets every day. And so that was another kind of early recognition that helped us steer the product development, which I'm happy we listened to those voices telling us, you guys need to do this.
I think if I look back on the kind of the journey that we've been on, when we first set out down this path. You know, as Brian said earlier on, people question our sanity and whether or not we would be able to deliver on this. And now that we've had, you know, a good 18 months of stealth mode behind us, a good year's worth of operating on our version 1, I think the first evidence of that we are really on the right path is the oversubscribed seed round, which we had $11 million seed round, and more than half of that came from strategic investors who see the potential of what we're building, because they're these crypto native institutions who have reached the limits of their existing infrastructure and need to be able to have an institutional grade infrastructure. And that process has been repeated again in the private token sale that we've just recently completed, where we have the same cocktail of financial crypto investors and strategic investors who want to build on top of the platform. And again, that was oversubscribed. So now that we're seeing all of this kind of coming forward into the market and the potential of what this can deliver, there is a lot here, and there's a lot to get your head wrapped around. But and we're in the early stages of this journey. But there is an enormous sea change that a network like ours will be able to bring about into the market in terms of providing deeper liquidity, providing capital efficiency, and as well giving broader access to the crypto market across the board, not just institutions, as well as retail users.
Yeah, we've had a phenomenal reception, I think it's fair to say, from both, you know, the crypto native users and builders in the space, existing huge businesses that are now supporting us and getting involved and building on the network, down to financial investors that see the pivotal place that Qredo will have, we believe, in the crypto infrastructure of the future. So part of that journey that we're on is going from this, I guess we can call it functionally decentralized, architecturally decentralized, but centrally operated architecture we're in now, to various shades of decentralization, and we have a roadmap to that. Why are we going on this journey? What you know, one investor said to me, what possesses you to go through the hard yards that you need to go through to decentralize the network fully? Why do you have this labor of love? Why are you doing this?
Yeah, so I think I'll take this one because you know, this is my fault, or this is my fault if it goes a good way, either way you look at it. But you know, if you talk to any sort of guru or even a venture capital investor in this space, they'll tell you never do what we did. Never start with a centralized application and go into and try and make it decentralized. Well, we didn't exactly do that. What we did is we took all the bits that were a truly decentralized application, and organizationally, we ran them all ourselves as Qredo Limited. That's our version 1 protocol. It is a decentralized network being run by one organization. Now, naturally, that makes it not decentralized. You don't get the benefit of having different organizational entities in different geographies running different validator nodes and different MPC nodes that give it the level of decentralized robustness and security that you inherit from that architecture. So the reason why we did this is because we needed and wanted to get on top of the organizational learning that would come from essentially stepping into our customers' shoes, the folks that were either running validators or running Qredo clients in order to execute trades, or putting money into the network, or putting digital assets into the network. We wanted to experience what they would be experiencing. And that way we could apply a level of rigor to the development and a level of speed to the development that would enable us to onboard all of that learning quickly as we then went to develop version 2 and apply that all into the version 2 protocol, which is a significant upgrade, not only in terms of functionality and security, but in the way that new entrants and new participants into the network, like validators, can quickly onboard, quickly stake, and then quickly get up and running and help secure the network. So I think we went about doing it the right way. And lastly, I'll just say, a lot of folks go around to strategic investors or what they hope will be participants in the market with nothing more than like, we've got this great concept and a lot of hand waving, and here's our PowerPoint. We were actually able to walk into the door with a working application, and a working application that has no significant history of downtime, that has all the benefits of decentralization and is anti-fragile. And because of that, people were like, whoa, I can start using this today. This is the real thing. Yep, this is the real thing. And that really helped us. And so what I'd say to the folks back home is, don't listen to the experts. Do it your way. If you've got the passion that you think that decision is right, then go ahead and go for it.
Mm-hmm. And so in terms of decentralization, a core part within that is the Qredo token. We are now able to talk about it, and it's been much speculated on. People have been hypothesizing that we're going to do a token, and people are now seeing that the Qredo token is integral to the overall functioning of the Qredo network. Anthony, what is unique about the Qredo token, and why do you think that this will be a key fuel for the Qredo network going forward?
I think what we have done is taken a very, a fresh look at how should a token be designed in order to drive adoption and utilization of a layer 2. And a layer 2, particularly a layer 2 like Qredos, where multi-chain, multi-participant, multi-business models that need to be able to hook into it, you're building a marketplace. So you have to have a set of incentives that work for all of the participants across for the participants that are sensitive to speed and transactions and security, to the participants that are sensitive to cost. But ultimately, you have to design it so that it's designed for the user and not for the validators. And that's really what we've done. Is that's the unique take that we've built, is that the predominance of economic value is going to the users of the users of the network. So the people that are coming on to swap, store, or transact on the network, they are their fees that are associated with the network, also benefiting from rebates, significant and very generous rebates that are coming in Qredo tokens for their participation on the network. And for the other side of the marketplace, which are the liquidity providers and the market makers, we are embracing them as partners. So we're not charging them fees. We are granting them tokens. We are participating in based upon the assets they have staked and the transactions that they run across the network. And so with all of this kind of interlocking activity that happens within the Qredo token and with this user-centric design, it actually creates a really strong economic story for the validators on our network. So the validators on our network, they're not only able to, they benefit from all of the layer 1 fees that are being collected off the network that are used in order to acquire Qredo tokens on the broader marketplace, either from market makers within the network or from secondary markets, creating buy pressure on the Qredo token. And it's all designed back to this concept of what Brian was saying earlier of how do we turn custody into a yield? How do we turn this into a profit center? And the design of the token is fundamental to turning our utilization of the network into a profit center for the people that are users of the network.
Mm-hmm. Yeah. So then in summary, we've got a couple of incentives here within the network. We've got transaction mining for the users. We've got custody mining, so rewards for people holding their assets in the network. We've got liquidity mining, so we've got rewards and incentives for people providing liquidity within the network. And in addition to that, this income accrues with validators. People can then stake their Qredo token with validators to earn a share of the yield that the validators are accruing by, obviously being integral to the overall governance of the network. So we've got a number of incentives that we've built in and hard baked into the network to drive transactions, assets on the network, and really what we're aiming for is a network effect. I think that's fair to say, right? It's a network effect that we're pointing at that will be accretive to the users, as well as it will be to the overall kind of Qredo token holders, to create this really interesting, exciting dynamic between usage and a token. So a lot to unpack there. We could probably even just have a
session on its own, yeah.
Just the token itself, right? Maybe we will. Maybe we got time for that. So we've covered a lot of ground. I'm just conscious that we're coming up to the end of the hour today. But I think what we'll do, because I'm sure we're going to get a lot of questions after this, is set up another time to do a bit of a Q&A with the community, to do some kind of community-driven events where people can ask questions. So if you're watching this, do feel free to reach out to us. We would love to hear from you. We are on Twitter and Telegram at Qredo Network. Follow us on Twitter, join our Telegram group. We are always present there. So if you have questions for us, fire us a question over there and we'll get back to you as soon as we can. We also have our CoinList sale on the CoinList platform in the beginning of July. So keep your eyes peeled for more information on that. But for now, Anthony, Brian, thank you for joining us this week. Thanks for walking us through the high points of the Qredo network. And yeah, super excited to do more videos with you guys and tell the people a little bit more about what we're doing.
Thanks so much, Josh.
Cool. Thanks, Josh.